Does the market not believe these Fed officials that are coming out and trying to walk back the dovish Powell?
Well, Sarah, there's a little bit of momentum in the summer rally that we have, and I think people are more focused on that and maybe maybe they became a little bit overly defensive around the June low. But now we're up about 14%, and I think they're ignoring some of the issues that are out there. It's interesting that Jim Bullard said that we're not restrictive. We're at 225. He wants to go to 3.75 to 4%. I can't see how that's a really great thing.
Right. So there's that, and there's the fact that we're starting to get a mismatch between where the market is pricing the Fed and what the Fed is saying. Isn't that a risky thing for the markets?
Yeah, Sarah, it's a whole thesis behind the summer rally that we had. Remember, you're in the middle of the initial move. The initial fear is that what is the Fed going to do and how's it going to impact the economy? That was the first move lower. Now we're in okay, it wasn't as bad as we thought. The economy's okay because it works with a lag. I think, again, our call for the fall. So, once we look through the summer rally, which I think we're pretty close, you get to fall when you actually get the fear of what's happening. Remember that interest rates work with a lag. It's widely expected. This is a pretty funny range. It takes 3 months to 18 months. That's the spread of what economists think. Right?
Thanks.
So silly. Let's take the shortest one, 3 months. So that means we're just discounting the first 25 basis point hike. So in our opinion, it looks more like the economy has slowed down because of the fiscal cliff, the ending of extra unemployment benefits and other pandemic-related fiscal stimulus. And now, unfortunately, as we go into the end of the year, I think we're going to have the impact of those higher rates. And again, the whole premise here, where I really screwed up in 2020 was after the initial surge. I think we did a really good job of identifying that. I think similar to the summer rally here. Where I made a mistake was I didn't get really bullish right away. I thought the market would test the low, but then I ignored that the Fed had already started easing, and that is really what's different here. Not only has the Fed not started easing, they've not announced that they're buying corporate debt like they did in early April, the game-changing decision on April 9th, buying high-yield debt. They're actually telling you they're almost going to double rates from here. So I'm having a hard time buying an up 14% tape. Yeah. Well, I'm not as worried about QT.
You're calling an end for the summer rally.
If I were that good, I'd be on my yacht, but I'm not. I think we're really close. Remember,
okay. So Tony, we're 14% off the lows. We're about 14.5% off the lows in the S&P. You think that that's sort of where we should be after the oversold conditions where we were going into June?
Yeah, the environment was ripe. You had that oversold condition. We came up with the indicator on the rate of change for the 10-week rate of change in the S&P we talked about last time I was on the show. We hit the median plus a little bit of what upside you should expect. So the short answer is yes. But again, the conditions that were there were not just the oversold condition. It was that the economy was already in recession. And I disagreed with that. It takes time for that to take place. With 7% nominal growth, copper still above 300. There's things that you could look at and say, wow, they're down from peak, but they're nowhere near recession levels. And I think that's where we're going to have to look out for in the end of the year, is as you get that weaker data and those indicators coming close to a recession level, what it's going to mean to the idea that we're just going to have this soft landing.